New headlines, the world is grappling with what Biden will deliver and what Putin wants in terms of how you pay for his gas, and he wants rubles. When you look at this country, commodity boom, fiscal boom, but there's a real risk with oil at $120. Square that away for our viewers this morning.
Yeah, certainly it is a very difficult situation to try and forecast accurately, but our current best estimates are that if oil remains around about $120 a barrel, that is likely to take about 0.8% out of South Africa's GDP, all other things being equal. However, if commodity prices remain at current levels, that's likely to add about 0.6%. So definitely a negative, but perhaps a smaller negative than many other emerging markets.
Do you think there's a beginning of a second bite back? I'm looking at consumer confidence here. It's deteriorating. Are you seeing any fissures in confidence in corporate lending? I know you were quite bullish recently, but any cracks in the dam?
We're definitely seeing uplift in confidence. I think South Africa as an investment destination when President Ramaphosa came to power was a turnaround story. And it was a turnaround story that disappointed for the first 2 to 3 years. And what we're starting to see now is some real evidence of structural reform in the electricity sector and in things like the spectrum auctions. And all of that puts confidence into the system.
The other event today, as well as this investment event, is the Reserve Bank having their meeting. Now, it's assumed that they'll go by 25 basis points. Do you think, how many rate hikes do you think that they can deliver this year to deliver a soft landing in this economy?
Yeah, so, we have previously forecast another 4 rate hikes during the course of this year of 25 basis points, so 100 for the full year on top of the 25 that we got last year. And we still think that is what the Reserve Bank will do, notwithstanding the pressure on inflation that has emerged in the last month or so.
Well, the question is, that, the Fed, we're hearing message after message, they're going to go 50 basis points, 7.5 rate hikes this year. That puts more pressure on the Reserve Bank, but it could bolster the currency. It's the third best in the EM space. Talk me through, do you think the Fed will do 7.5 rate hikes, first of all, and the impact for you?
Well, I think, most central banks at the moment are talking up the number of rate hikes they're going to deliver and then looking at relatively low levels of economic growth and trying to talk more than deliver the rate hikes. And I think that's certainly going to be true here in South Africa. Very low levels of growth. The inflation that's coming in is largely imported inflation. I think that there isn't enough demand in the economy to see material second-round impacts. So we'd stick with our 100 basis points irrespective of what the Fed is doing. And if you look at the rand, we all know it as an extremely liquid emerging market currency. It is the canary in the coal mine for how markets see South Africa and emerging markets in general. And that 8% strengthening that we've seen since the beginning of the year definitely tells us that the markets believe on a relative basis that trade-off between higher oil prices and higher commodity prices is in our favor.
And that performance, if you think about it, up nearly 8% so far this year. Your inflation is below the EU, it's below the US, and it's below the UK for the first time since the early 2000s. The currency rallied by 10% then. Do you think there's another 10, 15% left in the rand?
Well, it's very difficult to call, and I think a lot will depend on how long commodity prices remain high. And if they do, absolutely, I think there could be that much upside in the rand where it currently is, particularly if we continue with material structural reform. So it's not only a trade story and a flows story, it's a structural reform story.
You would say that structural reform has improved more recently. What is the key piece of evidence for that?
Yeah, so it has. We've been extremely critical about the slow pace of structural reform. Key pieces of evidence in the electricity environment, the enablement of businesses to generate up to 100 megawatts of self-generation. Really, really important given our electricity supply constraints, as well as the spectrum auctions that after 10 years of delays were finally completed last week.
So this all does play into your energy needs. You say, look, at these levels around $120, you've run the numbers in terms of the add and detraction. It'll be a net drop for the economy. Do you think anybody's prepared for oil to go to 150, as I saw Trafigura say this morning? Are you ready for $150 oil?
No, that's certainly not our base case, but we would run scenarios on either side. And, 150 would clearly be materially more difficult than 120, but it'll be interesting to see what happens to other commodity prices if that's where oil goes.
One of the big arguments about the flow, the emerging market flow, is that it would come out of Russia, flow into my world in the GCC. But do you think that the flow, the move in the rand, the move in commodities here is driven by hedge flow? Are you seeing a momentum gathering from the hedge funds into your market?
Well, we've certainly seen increased inflows into both bonds and equities from foreigners. Whether those are hedge funds or long onlys, I don't have the detail for that. But on a relative basis within the emerging market basket, certainly South Africa is looking attractive given the challenges in areas like Russia and Turkey.
Look, I just want to come back to the net zero. It's part of the conversation that we have with a lot of CEOs. I know that Nedbank is at the forefront, as it were, on that. But you have got this funding call for Eskom. It's you and a number of other banks as well. They are one of the biggest CO2 emitters. Is that going to materially delay your net zero targets?
Well, we've set our net zero target for 2045, so that's not going to be delayed by anything. And what's important is that we need to manage a just transition. So we are managing down our exposure to coal producers and coal-fired electricity, but we need to do that in a way that there's still enough electricity in the country for businesses to operate and for people to have lights and heating in their homes. So it is a very delicate balance.